Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so. Economic activity expanded at a robust pace last year, reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected, as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer-run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. For the first question, we'll go to Chris Gerber at the Associated Press.
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred to in my opening statement, it is not possible to predict with much confidence exactly what path for our policy rate is going to prove appropriate. And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So, more to your question. We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're at right now as maximum employment, and also along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Sorry, just getting both parts of your question written down. So I would say, and this view is widely held on the committee, that both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic. And I would say that most FOMC participants agree that labor market conditions are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability. And that is my personal view. And again, very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds rate. The other thing is maximum employment will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum of employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the policy path that we're broadly contemplating would be supportive of that outcome as well. So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market. And my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And of course, we're prepared to use our tools to assure that higher inflation does not become entrenched.
Thank you. Let's go to Nick Timros at the Wall Street Journal.
Good afternoon, Chair Powell. Nick Timmerhouse of the Wall Street Journal. I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then, apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales, or changes in the composition of reinvestments? Thank you. So
I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, and then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter duration than the last time, and the economy is much stronger, and inflation is much higher. So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number one, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate. We want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
So if I could follow on that, raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every quarter percentage point increase in your benchmark rate?
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs, I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think the pattern we'll follow is to arrive at a timing and a pace and composition and all those things, and then announce that with advance notice, and it will start in the background, and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
Thank you.
Thanks. Now we'll go to Neil Irwin.
Thank you, Chair Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy. Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations, so that in and of itself is appropriate.
Thank you. Let's go to Howard Schneider.
For a year or hi. Thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements reference the benchmarks for this initial interest rate increase. now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
Well, you're right. We haven't gotten to that point yet. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so. We have our eyes on the risks, particularly around the world, but we do expect some softening in the economy from Omicron, but we think that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
If I could follow, just on a related question, the December SEPs had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
The path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation that we're seeing, does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will be providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason, the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
Thank you.
Thank you. Let's go to Gina Smialek. Let's go to Gina. Okay, let's go to Steve Leisman.
Thank you, Mr. Clinton. Thank you, Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of the technical question part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principle says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserves regime. So there's a substantial amount of shrinkage in the balance sheet to be done. That's going to take some time. We want that process to be orderly and predictable. And so those are some of the ways I would think this lays out our, the way we're thinking about this. In terms of the timing, I can't really help you. It just says after we get underway. So I would say we're going to have another discussion at the next meeting, and my guess is we'll have at least one other discussion at the meeting after that, and we'll tell you as we make progress, and we'll start the process of allowing runoff and shrinking the balance sheet at what we find to be the appropriate time. I wish I could say more, but honestly, we haven't made those decisions, and we actually haven't even really had the important discussions on a lot of the details that we will have at coming meetings.
Thank you. Let's go to Craig Torres.
Chair Powell. Chair Powell, good afternoon, Michelle and Chair Powell. Craig Torres from Bloomberg. Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing? Is Fed policy a risk, over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions. In a couple months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of things. And next to those transactions, we'll put dates. And Bloomberg asked for the dates of Mr. Kaplan's transactions. The Dallas Fed is not giving us the dates. And I don't see why this is a matter for the Inspector General or anybody else. I mean, why can't he give us the dates? Will you help us get the dates of those transactions? Thanks.
So you asked about the risks first. So the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that the high inflation we're seeing will be prolonged, and there's a risk that it will move even higher. So, and we don't think that's the base case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one where inflation remains higher. And of course, that is a risk to the expansion. We've been saying that what we need here is another long expansion, which is the kind of thing we saw over the last, which is the record long expansion. We saw labor force participation rise. We saw wages persistently higher for people at the lower end, and there really was no obvious imbalance in the economy that threatened that expansion. It could have gone on for years were it not hit by the pandemic. So We'd love to find a way to get back to that. That's going to require price stability, and that's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. So I mentioned two-sided risks. A couple things. One, the COVID is not over, and COVID can continue to evolve, and it's just we have to accept that it's not over, and the risks to it can slow down growth, and that's sort of a downside risk from a growth standpoint. I would point to another risk is just further problems in the supply chains, which could slow down activity. And you see the situation in China as a situation there where that's their no COVID policy may cause more lockdowns, is likely to, and that may play into more problems in supply chains. In addition, there's what's going on in Eastern Europe and things like that. So there's plenty of risk out there, and we can't forget that there are risks on both sides. So that's there. That's what I would say. I know you've been all over this issue with my colleagues, Craig, on the issue of information. We don't have that information at the board, and I asked the Inspector General to do it.
Breaking news there. Federal Reserve Chair Jerome Powell saying the Fed will likely hike interest rates. The decision will be made at the FOMC's March meeting. The Fed is firmly committed to slowing the rise of inflation. What you're seeing here is live video from the Fed Chair's news conference following today's Federal Open Market Committee meeting. You're watching All About Bitcoin, a show dedicated to all things questions and markets related to Bitcoin, little B for the currency and big B for the network, a collective journey to understand, apply, and use innovation, all Bitcoin, all the time. I'm your host, Christine Lee. So markets are reacting. The Dow Jones Industrial Average turning negative. Let's take a look at Bitcoin right now. The CoinDesk Bitcoin price XPX index is at 37,189, down from earlier highs. Right now, just making it a slight advance, about 0.5%. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So look at some other top stories moving markets. The International Monetary Fund is urging El Salvador to discontinue using Bitcoin as legal tender because of potential risks to the country's financial stability, integrity, and consumer protection. The recommendation came in a report issued on Tuesday following bilateral discussions with El Salvador about its economy. El Salvador has been in negotiations with the IMF for a $1.3 billion loan. And meanwhile, Russia President Vladimir Putin offering hope for crypto, saying concerns should be offset against, quote, certain competitive advantages that Russia holds when it comes to mining due to the country's surplus of electricity and well-trained personnel. Putin asking government ministers for some kind of unanimous opinion as the country's finance ministry opposes the Bank of Russia's call to ban crypto on the grounds that it would undermine the industry's technological development.
The chart of the day is brought to you by Crypto.com, the world's fastest growing crypto app.
Predictions for $100,000 Bitcoin have been deferred indefinitely as Bitcoin enters choppy waters, about 45% down from its all-time high. But that's not stopping stalwart bulls from predicting Bitcoin's rise to $1 million over the next decade. ARK Investment Management, the firm led by star fund manager Cathie Wood, predicting that Bitcoin's price could exceed $1 million by 2030 as the cryptocurrency's global usage is still only in its early days. ARK analyst Yassine El-Mandra tweeting out this chart saying that Bitcoin's market capitalization still represents a fraction of global assets and is likely to scale as nation-states adopt it as legal tender. The firm's Big Ideas 2022 Outlook report outlines how Bitcoin will eventually reach a market capitalization of almost $30 trillion as Bitcoin takes more market share as a global settlement network, with its annual settlement volume already surpassing Visa's annual payments volume, according to ARK. Joining us now to discuss is Ross Gerber, CEO of wealth and investment management firm Gerber Kawasaki. Hello there, Ross. Thanks for joining us. So,
hey,
1 million Bitcoin, is that plausible?
well, Kathy's made some pretty big number calls in the past, and some of them have been right. I don't really look at Bitcoin that way, in the sense of our goal isn't necessarily to see how much we can get Bitcoin to appreciate, as much as building utility around cryptocurrencies so that they don't depreciate. And I think we oftentimes get distracted when Bitcoin's rallying. That utility needs to continue to be built into the crypto system, whether it be with altcoins like Doge or Ethereum or whatever. And I think that's the most important thing. The ecosystem becomes usable for companies, institutions, and individuals in a way that will institutionalize crypto assets as a way of life. And the more that happens, the more value will be gained by Bitcoin. But I think the thought process around price is more detrimental to Bitcoin than necessary.
All right, fair enough. We've got the Fed meeting going on, but we do have markets reacting to Fed Chair Jerome Powell's news conference. We see the Dow is turning negative. Bitcoin is off from its previous higher recovery this morning. How do you interpret the price reaction?
Well, I mean, we're seeing rates just kind of shoot up. Right now, I think it just hit 1.84, almost 1.85. So that's going to put pressure on Bitcoin and equities, because Powell actually was sort of like more dovish, meaning that we'll have more growth and probably a less aggressive tightening cycle than I think people were perceiving. And then, the 10-year rate kind of shoots up, because it's like, oh, okay, we might actually not kill the economy by raising rates. And so I have a lot of faith in Powell, and I think the right things need to be happening right now, and rates are going higher. I don't see that as a bad thing.
It's interesting you say that his speech is dovish. So is that surprising to you? And what did you get out of it?
Well, I think he really understands that data changes very rapidly, especially with coronavirus and the uncertainties that have been created in the supply chain from the various factors that are very sort of unnatural behaviors. And so he has to maintain the flexibility he has to make adjustments to what he may perceive as risks to growth or risks because of inflation. And so it seems right now the higher risk is towards inflation, and that's why rates are going higher. But I think he was pretty, how would I say, unclear about what he was going to do with the balance sheet and when. And so I think that's the dovish part of the speech. We know he's going to raise in March. We know that tapering is happened. So I think the real question is the speed of the rate increases and the getting rid of the balance sheet. But the bottom line is I have faith that he's going to do this right. What he said that I think most people oftentimes miss is that his goal is to have another long expansion with lower inflation like what we had under Obama for a very long time. And so if that's his goal, this adjustment cycle is presenting a great opportunity for long-term investors.
All right. So what was behind this past weekend sell-off then? Was it global market jitters, concerns over more hawkish central banks? Have the sellers stopped selling?
Well, no. I mean, I think the market was very expensive, and you had a lot of froth, and you have things like NFTs and speculation, all over the place, and it's not healthy for the economy or people to be gambling all their money all the time. And that's a byproduct of zero rates and printing money and sort of this like unlimited zero cost money. And so now with the Fed in action, putting pressure on risk assets like Bitcoin, it really actually just creates a more honest market and a less speculative market, which is actually what we prefer. I think even though a lot of people might not like losing money on the short term, which I fully understand, that's part of the process. Okay, like markets don't just go straight up. There's lots of bumps in the road. And I think a lot of newer investors are learning the realities of investing. Is what we do is very hard as professional investors, and it's going to be a difficult year. There's no
Right.
spin on it.
So in another story we're watching right now, the IMF is urging El Salvador to stop using Bitcoin as legal tender. They're in the middle of negotiating a $1.3 billion loan agreement. There are a lot of geopolitical, socioeconomic dynamics at play here. How do you see things shaking out?
Well, that's a good one. El Salvador has a lot of unique issues that I think are irrelevant of the greater idea of having Bitcoin be your currency. You know, for the El Salvadorian people, there's nothing better for them than having Bitcoin instead of the El Salvadorian money, which probably has no value. And I think most countries will be better served having Bitcoin as their currency than their current currencies. But they do this so that they can print money and do whatever they want to do. And so I think, you know, countries around the world, you know, and including the IMF, have a
Well, they have a
large
dollarized
incentive.
economy, so
Yeah, and they have a large incentive to continue that system of inflationary money printing to support government spending and all the initiatives that they want to do that they can't afford. So there is risk for countries moving to Bitcoin because they have to be responsible and not print money if they go to Bitcoin. And it presents a lot of the same problems that when countries are on the gold standard that they used to have, including the United States. So although I like the idea of countries, you know, going to Bitcoin, it doesn't necessarily serve their governments that well if they're not responsible. And I think a country like El Salvador has never proven to be that responsible with money. So I think
well, they're relying on the dollar, so they
unprecedented
can't
time.
print U.S. dollars and you know, control.
Yeah, but that's, you know, their economy sort of works. It's so messy, you know.
Yeah. Well, I guess the IMF's point is that this makes things messier. But
You know, but what I do think is that if I was a person in El Salvador and I was getting paid in Bitcoin, I'd be a lot happier than any other currency, right? And so they've digitized their economy, and I think a lot of countries should consider this as a way to go moving forward. But it will create a responsibility among those nations that would be beneficial, I think, over the long term, but take away a key element of power that these countries have in printing money.
all right, Ross, thanks for weighing in. Appreciate your insights. That was Gerber Kawasaki CEO Ross Gerber. Coming up, a look into Bitcoin trading and mining in China with PE and VC firm Youbi Capital. Hi, I'm Christine Lee.
Zach Seward. I'm Michael Casey.
I'm Christy Harkin.
I'm Isaiah Jackson.
I'm Serena Lynn.
Hey, this is Will Foxley.
I'm Teresa Santos.
Hi, I'm Lawrence Lewitton.
Hi, I'm Doreen Wayne.
I'm Nicholas Day.
Hi, I'm Kevin Worth.
My name is Naomi Brockwell.
I'm Jordan Muthra.
Hi, I'm Galen Moore.
Hi, I'm Brad Count.
I'm Pete Paschal.
Hi, I'm Jen Sanasi. You're watching, and you are watching.
And you're watching CoinDesk TV.
Welcome back. Bitcoin rising from deeply oversold levels over the past 2 days, indicating renewed buying after a sharp sell-off. The cryptocurrency faces initial resistance at $40,000, according to CoinDesk's Dominic Dantes, which could stall the current price bounce. Joining us now to discuss is Chen Li, CEO at PE and VC firm Youbi Capital. Welcome, Chen. So we had a major crypto market sell-off over the weekend that has mostly recovered. Is there any difference in trading activity in Asia compared to North America?
Yeah, so I think for a lot of these, so China used to be dominated by a lot of Bitcoin miners, and a lot of them have already moved to Singapore or other countries to kind of try to escape the crypto ban in China. So a lot of them, they have held on to their Bitcoin, and you know, they have the mindset of, okay, so maybe we are entering a new cycle, a potential bear market. So what kind of asset we are going to kind of hold through all this volatility. So, you know, in the last cycle, we saw that there were a lot of turnovers in top 20 to 50 tokens or coins. But Bitcoin and probably Ethereum remained. So I think the chances that, okay, so the Bitcoin and Ethereum probably are going to survive the this bear market, and you know, so those are the assets that are worth holding with all these potential sell-offs. And
there's a lot in there I want to kind of dissect. So the miners had to leave. Are they having to sell their Bitcoin in order to pay for whatever expenses they have to pay for in that move? And are they selling, if they're into altcoins, do they have to sell their altcoins for BTC because, they need to get off into on and off on ramps with fiat money, and so Bitcoin is an easier way to do that. So they have to sell their altcoins for Bitcoin and then exit the market if need be through Bitcoin. Do you see that happening?
Yeah, I mean, there definitely has been some consolidating. So a lot of Bitcoin miners or crypto holders have definitely diversified and took the opportunity in the last 12 to 18 months to make a lot of profit in altcoins. But as they're seeing this incoming potential bear market, they definitely retreat into Bitcoin or Ethereum. But I think in China, when it comes to paying all the fees, in terms of moving facilities from China to overseas, I think all those fees are mostly paid in Tether or stablecoins instead of Bitcoin. So because the transaction fee is much lower in terms of using USDT. But it's very interesting that in China, people are mostly using USDT on Chen network instead of Ethereum or BSC. So because Chen has provided a lot of incentives to the exchanges to use them.
Well, most miners from China estimated they would come back online in this first quarter of this year, according to Compass Mining. But is that the case? Do you think mining will ever come back?
So.
Okay.
No, I don't think so. It definitely doesn't come back in China, but the Chinese regulation has been a myth to us. This morning, I just saw the news that the Inner Mongolia government, the Inner Mongolia province, the government just announced the order to provide electricity to crypto mining at a higher price, which means that they are potentially lifting the ban on crypto mining in that province. So it just comes after probably the most strictest crypto ban in China. So, but the problem is that after all these uncertainty on the regulation, I don't think the miners are coming back to China. But also going overseas, they have seen a lot of problems. They haven't been able to find a lot of reliable mining facilities in North America to host their miners. So in my circle, when I talk to the top 10, maybe 5 to 6 people of the top 10 Bitcoin miners in China, I think on average, they only moved about 10% of their previous capacity overseas. So yeah, it's going to take a long time for them. I think a lot of them, the mining rigs are still in the warehouse.
Oh, wow. The Lunar New Year and the Olympics are coming to China. I wonder how that might impact trading in the region.
Yeah, so Chinese New Year is usually a time for people to close their books, to pay all the bills. But I think, the migration of miners already happened over the last 6 months. I don't think there is going to be a lot of selling of Bitcoin or crypto to fill the gap in cash. So, but on the other hand, I think Chinese New Year's are time to get together. So we believe there's going to be a lot of talk about crypto at the time. So potentially there may be some more pickup in acquiring Bitcoin.
Well, you mentioned that most of the mining equipment is stuck in warehouses now. Do you just not see it coming back online? Is China mining dead?
Yeah, I think in the recent future, and unless the crypto miners saw a more consistency in the policy making that the China government allow or even incentivize Bitcoin mining, or if it comes from like the president, like what happened in Russia, then I think
Don't know
it
if
may
that'll
happen, but that is
don't know
part
if that'll happen anytime soon, though, Chen. Well, thank you so much for coming on the show. Appreciate your insights. That was Youbi Capital CEO Chen Li. All right, that's it for All About Bitcoin. I'm your host, Christine Lee, and we'll do it all over again tomorrow at 3 o'clock in New York. Also, join us tomorrow morning at 9 a.m. Eastern for First Mover. You're watching CoinDesk TV.
Interest rates. But it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many other financial conditions as we try to assess the implications of all those conditions for the economic outlook. So that's one thing I would say. Another is currently you've got a slope, if you think about 2s to 10s, two-year Treasury to 10-year Treasury, I think that's around 75 basis points. That's well within the range of a normal yield curve slope. So it's something we're monitoring. We don't think of it as, I don't think of it as some kind of an iron law, but we do look at it and try to understand the implications and what it's telling us. And it's one of many things that we monitor.
Can I follow up real quick and ask if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time.
Thank you. Let's go to Brian Chung for the last question.
Jerome Powell, Brian Chung, Yahoo Finance. Within the context of just the broad effort to normalize rates, would you describe what you want to do as a gradual hiking? And then secondly, within the context of hiking cycles, it's often the talking point for financial stability and wanting to make sure that asset bubbles don't merge. Is that something that has also factored into the conversation as you start to think about hiking rates? Thanks.
I would describe what we're doing along these lines. This is going to be a year in which we move steadily away from the very highly accommodative monetary policy that we put in place to deal with the economic effects of the pandemic. And that's going to involve a number of things. It's going to involve, and it does involve, finishing asset purchases. It's going to involve lifting off, and it's going to involve additional rate increases as appropriate. And we're going to write down in March our next assessment of what that might be. It's going to continue to evolve as the data evolve. We need to be quite adaptable, I think, in our understanding of this. The last thing we're going to do is we're going to have a couple more meetings, I think, to talk about allowing the balance sheet to begin to run off and do so in a predictable manner. And that's something that we will also be doing as appropriate. And I wouldn't, I don't think it's possible to say exactly how this is going to go. And we're going to need to be, as I've mentioned, nimble about this. The economy is quite different this time. I've said this several times now. The economy is quite different. It's stronger. Inflation is higher. The labor market is much, much stronger than it was. And growth is above trend, even this year, let alone last year. So all of those things are going to go into our thinking as we make monetary policy. And you asked about financials to have concerns. In connection with our policy, was that your question?
Yeah, within the context of other hiking cycles, it seems like worries about asset bubbles emerging as a result of easy rates has been part of that. I didn't know if that was part of the discussion today.
I would just say this. We of course, have a financial stability framework. And what it shows is a number of positive aspects of financial stability. But you mentioned really asset prices is one of the four. So asset prices are somewhat elevated, and they reflect a high risk appetite and that sort of thing. I don't really think asset prices themselves represent a significant threat to financial stability, and that's because households are in good shape financially than they have been. Businesses are in good shape financially. Defaults on business loans are low and that kind of thing. The banks are highly capitalized with high liquidity and quite resilient and strong. There are some concerns in the non-bank financial sector around money market funds, although the SEC is has made some very positive proposals there. And we also saw some things in the Treasury market during the acute phase of the crisis, which we're looking at ways to address. But overall, the financial stability vulnerabilities are manageable. I would say.
Thank you very much.
Thank you.